In today's video, we're talking about direct indexing, an investment strategy that can maximize tax savings. Direct indexing is an approach to index investing that involves buying the individual stocks that make up an index in the same weights as the index. This is in stark contrast to buying an index fund like an ETF, an exchange-traded fund. Direct indexing buys up the stocks that make up that ETF. So why take the trouble to buy each stock instead of just getting an ETF? I mean, isn't getting exposure to tons of different companies without having to buy each stock kind of the whole benefit of buying the ETF? Well, direct indexing allows for an enhanced way to do tax loss harvesting, but on steroids, because of the additional opportunities that it can create. Instead of only looking for opportunities to harvest losses across ETFs, direct indexing can take advantage of daily movements in individual stocks. If you take VTI, for example, VTI tracks over 4,000 companies. On any given day, even if the entire US index is trading up, there are bound to be some individual stocks trading at losses. That's a lot more opportunities to find tax loss harvesting opportunities than if you just bought VTI on its own. If you're thinking that this sounds pretty cool, but also pretty complicated, I have to plug Wealthfront right now because we offer this service when your investment account reaches $100,000 at no extra cost. You can choose a portfolio that's 100% direct indexing, or if you want, include it as part of a more diversified portfolio. The choice is yours. We only support this in taxable accounts over $100,000 as we need enough of a balance in the account to purchase all the US stocks and the ETFs needed for the full asset class exposure. In this case, the US. So how does it work? Direct indexing purchases the stocks up to 100 or 600 depending on your account size with the largest market capitalization in the US equity market. So we're talking, Apple, Google, Meta, etc. That's why we need a $100,000 minimum in the account. Some of these stocks are super expensive. To make sure that you're fully invested in the US market, we'll also buy completion ETFs that track the companies outside the large cap companies, so you're still getting exposure to those smaller cap companies. This allows us to aim for the same returns of the index that we'd normally use for US stocks. Now, you can't really understand how powerful direct indexing really is until you understand tax loss harvesting. Here's how it works. When an investment in your Wealthfront portfolio declines in value, meaning that it's currently sitting at a loss position, our software can sell that security, recognize the loss, then reinvest the cash right away in a substantially similar security. This leaves your portfolio with nearly identical risk structure, so you're still properly diversified. These losses generated by tax loss harvesting can then be used to your benefit to offset taxes, such as capital gains, that you might generate through selling securities or even ordinary income. We're so proud of this strategy that we even publish our annual results on the blog, something that I highly doubt you'll see any other service do. Check out the link in the description if you're curious. While we're at it, hit subscribe so you can follow along to all these videos. With direct indexing, by purchasing the individual stocks in an index instead of just the ETFs, there are many more opportunities for our software to take advantage of because, again, on any given day, there's likely going to be at least a few stocks trading at a loss, right? Even on days, like we said before, where the index is up, you might still find stocks to harvest losses with that are trading at losses. It simply can maximize the available opportunities to harvest losses. Another benefit worth noting is that it can reduce the amount of fees that you pay because individual stocks, unlike ETFs, do not have expense ratios. Let's look at a simplified example of tax loss harvesting in action. First, just with ETFs. We'll imagine that you have a portfolio with a share of VTI in it, an ETF that tracks the performance of the US index. If you bought that share for $350 and then one day the price falls to $349, you could sell your share of VTI, harvest that $1 loss, and then purchase a new similar ETF to replace it, like SCHB. This new ETF's performance is highly correlated with the performance of VTI, so you're still roughly the same level of risk. By purchasing an ETF that tracks a slightly different index, our software aims to avoid violating the wash sale rule. Now, I get it, harvesting a $1 loss isn't going to make much of an impact on your tax bill, trust me, but repeating this process over and over again for all the investments in your portfolio, many times over the course of the year, can make a massive difference. Now let's look at an example of tax loss harvesting with direct indexing. Imagine you have that well-diversified portfolio that includes a share of Coca-Cola, which you bought for $50. One day, the value of Coca-Cola drops to $49 a share. To harvest the loss, you would sell that share of Coca-Cola for $49 and then harvest the $1 loss in Coca-Cola's value. Now, you could then buy a share of PepsiCo, which is correlated and similar, so your portfolio would still be nicely diversified and it would have roughly the same level of risk. Again, you'd end up with a $1 loss to use against your capital gains or taxable income. Except now, if you're harvesting losses within an index, you should be able to harvest far more. Individual stocks are generally much more volatile than the overall index fund. And on a day when the index is up, individual stocks might still be down. As a result, you can boost your tax savings even further when harvesting within an index instead of just the ETF. Direct indexing looks for these opportunities every single day. Now, how can you use the harvested losses? You can apply harvested losses to offset short-term capital gains, so securities that you bought and then sold within a year. You can apply your harvested losses to offset long-term capital gains, and these are securities that you waited for more than a year to sell. You can use the losses to reduce your taxable income by up to $3,000 per year, or you can carry forward your tax losses to future years, even if you don't have any capital gains or income to offset. Either way, you're going to use it at some point. Now, for comparison, many human financial advisors only do tax loss harvesting once a year, or maybe once a quarter if you're lucky. We look for these opportunities through software every single day. Again, our direct indexing is available at no additional cost in taxable investment accounts with over $100,000. And we're the only robo-advisor that offers this with tax loss harvesting. If you're interested in direct indexing, here's how you can add it to your portfolio. And you can also check out our white paper, which is linked below. To add direct indexing to your portfolio, log in, go to your main page. Simply click the search button at the bottom. And what you'll see is you have 3 different portfolios in here. You have the classic, socially responsible, and direct indexing. You can also search for anything you want down below. We won't get into that as we have another video covering how to explore all the investments within Wealthfront. For today's purposes, you can simply click the direct indexing portfolio. What you can do is take a look at the overall performance, expand the history, kind of get an example of what this looks like in a Wealthfront classic portfolio. For this example, we'll just simply click Add Portfolio. And what you can see is you have the opportunity to add as a new portfolio or switch an existing portfolio to direct indexing. Now again, you need over 100K to do this. But even if your account is under 100K, you can switch your portfolio to direct indexing so that when you get to that level, it'll automatically invest in these individual stocks. Let's assume that you already have an account. You can click Switch an Existing Portfolio, and then you can decide which account. Now, we'll choose the taxable account because that's the only one available there. You can then decide on the risk. For this case, we'll go with the default risk here and click Continue. We give you a little pop-up to help you better understand what direct indexing actually does, which we talked about in the video. And then you can click Update Portfolio. Now, let's say you actually wanted to create a new portfolio with just direct indexing, which is becoming a lot more popular lately. Let's click Add Portfolio. Add is a new portfolio. All right, and then we recommend the classic portfolio to start. Let's say you want to just do 100% US direct indexing portfolio. Simply click the Edit Investment button. You would then increase the allocation in US direct indexing to 100. And then you got to go and decrease the allocations to all the rest of the portfolio. And click Continue. It'll then walk you through where you want to fund it from, but you have the option. The choice is yours. If you like direct indexing and you want to be a part of it, you can start from scratch with a new portfolio. When you start from scratch, you get to choose how much of your allocation you want to direct indexing, all the way up to 100%. This is Tony from Wealthfront. Thanks for watching.